It's weird to say that the recession is the good news everybody's been waiting for, right?
Or did we cause it, or was it there? That's the thing.
Good afternoon, welcome to Northpoint of View, here with Dr. Walter Kemmsies and special guest Toby Browne Jr. How are you?
I'm good. Gentlemen, good to be here.
Hey, Toby.
On the break, Walter, that was a great question. Wish we'd been filming, but we'll try to recapture it. I think your question to Toby was in regard to the local and regional banks being able to participate in this sort of surge of construction development, making the most of the opportunity or missing out on it, right?
Right. I've got a friend of mine. He's the CEO of the local branch of his bank. It's one of the big ones, big southern banks now. You just gobbled each other up. And I introduced him to I brought him to a JLL conference where we were talking about industrial real estate trends because all they were doing was residential real estate loans. And he wanted to get into industrial, but didn't know anybody, didn't know how. And he was shocked to find out that, we had people from outside of the state coming here to get involved in financing, the buildings, et cetera.
Yeah, bigger numbers, bigger deals.
Yeah. So that's what I was wondering.
What do you see, Toby?
I think they'd like to. I really do. I just think that it's one of those things that's really tough to build a risk profile around. It's really difficult to quantify. I think that they all know that there's money out there to be made in that process. I think that the issue becomes that it's that whole idea of risk-based pricing has kind of left, and it started to fall into more of tiers of lending, where your quote unquote commercial bank became your first tier that's going to have your lowest interest rate, but instead of something where they gauge the risk of it and look at the project, they're going to basically just say yes or no. So as soon as they say no, it really has more recently tended to go to private equity, and private equity either takes a share or they take a much higher percentage, and it's all just based on the risk qualifications of it. And so it just makes it more expensive, but it's happening. But I think that also leads to the inflationary aspect of it. I mean, you're paying more to do it. So.
Right. Is it the size of the deals, or is it just the product itself, or both?
Well, I mean, obviously it's always both. But banks can get involved in as big a deal as you think they want. If you want to build a hospital, there's a bank that'll fund that until it gets paid out. They'll do the construction part of it, because you can't, through the structure of a REIT, fund the construction part. So they can fund the construction part once it's all out there. But you do something that's pretty solid like that just has a very low probability, like a hospital in a municipality that's growing. But you start to do a broad neighborhood like you did through Northpoint 1. The broad neighborhoods, it's difficult to quantify the risk factors that go into it.
Sure.
Yeah, it's like financing a warehouse here in town for a local bank, whether it's a local or a state, is probably a much riskier proposition to them.
But they'll get into that. They'll get into it. You start to get up into the $20-30 million range. They can do it. If you start to do industrial real estate, you start to do the horizontal build on it, that you're going to have to go to private equity, and they're looking for that too. We've had a lot of luck in that. That's been one of those areas that Mark, why don't you talk a little bit about your feel for the market on that, because you're the one that has by far the most conversations when it comes to private equity's desire or willingness to get involved.
Well, it is interesting. I go back, a couple of years ago, talking to the large sort of local or regional banks here. They were competing directly with Boston and Dallas, right? And to your point, they absolutely had the capacity, but it's a new wrinkle for a lot of these folks. They see what's going on all around the community, but at the end of the day, if you've got a group in Boston that's been doing it for 15 years, to your point, it just comes down to a number. really, in a matrix, and something they're a lot more comfortable with, and can give you an answer in a pretty short, window of time once you get them all the information. So, and in deal flow in real world, it's time. I mean, you can't wait another 30 days for another committee to meet. At some point, if it's a half a point higher, but you can get the yes, you just go, right?
Well, and they recognize the margins. Like there's a lot of room for them to play within those margins. So it's like they're gonna make it easy, and it becomes where banks just don't operate on those tight margins. They can't have that same kind of and I would think it's due to regulatory restrictions, but they're not seeing it. They're seeing these safe risks for these large returns, and so it's just a place that they'll play.
And I'm not a good example. If you missed the last podcast, Toby validated that I was C- credit as of close of business Monday. So.
Well, how about that? I will say that I think that there is a parallel to the pre-recession, your ability to go borrow $5,000 from a bank or $10,000 from a bank. If an individual walked into a community bank and borrowed $10,000 because they had an issue in their life that they were just signing a personal note for, that was something that existed. That was something that we did. And, in my personal experience, those were kind of the safest loans that you had. That person was going to pay you back.
Right.
Post-recession, those became too much work for what was deemed the risk profile of it. Even though, because I'm looking at it on a very micro level, on a macro level, it's like there's no profile there. So if you can't understand the risk profile, then you just pull out of the market.
Right.
But what that did is it opened up. You have a lot more people doing like payday type lenders, a lot of very high interest, because people still need to borrow money on a short term.
Sure.
And if you borrow a small amount, and the interest rate is a small return, it's a high return for that lender on a macro level, and it doesn't feel bad to you, but on a global scale, the return on those would open up a lot of your title lenders, your payday lenders, things like that.
Yeah, and to that point, exactly right. After 08, 09, there wasn't a lot of real estate construction lending, for years, right? So,
well, not all over the country, but in most of the country.
Yeah. So they forgot how, right? Yeah. The local regional banks. And it'll be interesting to see, what's next. Because to your point, there's this crazy surge of big construction. Residential is strong throughout the Southeast. You go to Raleigh, you go to Tampa, you go to Atlanta, Charlotte, Orlando. It's booming. But you've also then got the manufacturing and the industrial warehouse.
Yeah, but see, to me, what's interesting about this is, before, the big boom in manufacturing construction, we struggled to get a lot of the big institutions to put money into Savannah.
Yeah, got it.
Savannah's a small market,
sure.
And so they just said if somebody leaves the building, we might not be able to lease it again for another year or something. So too risky. And so I would work with that team of friends of ours at JLL, and we got Goldman to put it on the investable geographies. I brought KKR guys down, gave them the tour of the port, etc. Their minds were blown.
Yeah.
But they couldn't convince their seniors at KKR that this was a good place to invest.
Yeah, but when Goldman came in, it was like the Good Housekeeping seal of approval, right? Then there was a flood of the other guys who came right in right afterwards, right?
Right, and you look at the port's marketing deck now, and they've got, financial institutions who are involved here. But the one thing they hadn't touched until now was a multifamily residential, or even residential, and we're seeing the private equities, guys stepping in. That's what's driving a lot of the home building, I believe. You would know better, because you know that market. But that wasn't like before. We didn't have those guys coming here.
Absolutely.
I think maybe that industrial comparison that you were talking about with Savannah, as far as bringing in outside money for that industrial space, and we were too small of a market to start or having to work to get in there, is probably pretty similar to what you were talking about with the neighborhoods. Right now, it's probably when Mark, you got started in residential neighborhoods, it's like somebody could jump in and buy a tract of land and build 30 or 40 houses. Now it just seems to be you probably come in with a large group, like it's very centered to large groups coming in and doing these very large scale neighborhoods, just because it's very difficult because that's going to be private equity, self-funded. That's going to be stuff that comes from the private market.
It's a mixed bag. You're right. It's either one or the other. There's nobody sort of in that middle space. Mm-hmm. So long term, Walter, big picture for the big guys. How are they looking at the next 12 months? If you're advising Goldman or whoever it is about what's next based on not the past 12 months but the next 12 months, what's the conversation like?
Yeah, the conversation is, why didn't we have a recession?
Okay.
And the probability of one was pretty high last year. And then a friend of mine from an engineering firm showed me the chart on the construction of manufacturing, facilities.
Right.
The curve has already peaked and it's starting to come down. I caught wind of that, and I didn't start off the year like the consensus view saying we're going to GDP 4% growth. I didn't go there. I said 2% plus or minus. First quarter, 1.6%. So we're cruising at a much lower speed than people thought. So that's my number one indicator, is what's going on with the construction part. It absorbed a lot of unemployed people. So right now, I think we can get through the year on low growth, so plus or minus 2%.
Yeah.
But we're sliding. I think we slide towards recession next year.
Which, Toby, to your earlier point, is sort of what people have been waiting for the last year and a half. Yeah. So I hate to say, it's weird to say that the recession is the good news everybody's been waiting for, right?
Did we cause it, or was it there? That's the thing. So
did we cause it? Was it already there? Thanks, guys. Been great to be with you.
Always good talking to you. Yeah.
Have a good afternoon.